let's take a look at the momentum that we're currently seeing on global markets. The Dow is holding up about that 11,000 point mark. Some analysts are cautioning that the market has risen too far. Do you share this view?
I mean, you know, the interesting thing is that if you look at the economy at the moment, you're sitting in this expansionary phase. So you've seen a bottoming out. And you've seen sentiment, you know, really negative sentiment about 12 months ago. And you've seen on the back end of that, you've just seen a complete change. And you're seeing the business cycle now actually expanding. And if you look at a lot of the economic data, you see that it's actually supporting the sentiment and the change in sentiment that you're seeing in the market. And yes, markets are, you know, on a relative basis, quite expensive from these levels. But the question is, where to from here? You know, how do you price something like this in? Because the cycle is expanding, you know, it might fill the void between where the markets are now and where economic growth is at this stage. And that's really the question that most investors are asking at this stage.
If one looks at world trade, it dipped somewhat in 2009, and we're seeing a bit of a pickup. Where are you seeing it going from this point onwards?
Expanding, definitely. I mean, world trade dropped off probably the most that it's dropped off in, you know, close to 3-4 decades. And the magnitude of that drop, we're just seeing an acceleration on the back end of that. And let's face it, I mean, most of that acceleration is on the back end of the very, very big monetary and fiscal stimulus that we've seen, you know, especially in Europe, and if you look at the Americas, should we rather say North America, where that has taken place. So if we didn't see the stimulus, we would never have seen the expansion that we're seeing at the moment. Obviously, the back end of this is that at some point this is going to start creating inflation, because world trade creates GDP, and you know, as GDP starts growing, you know, we're going to start seeing consumer confidence. You know, confidence has obviously picked up already, but we're going to start seeing employment numbers coming to the fore, and as that starts happening, you're going to start seeing, you know, inflation building. And the question is, to what magnitude does that inflation build? Because we've never quite been in a situation where we've been able to stimulate the world economy to the degree that we have.
We've got our inflation here in South Africa. It's between the target band of 3 to 6%. Should be lifting above the target band later on this year. As an investor, which asset class would you be going into looking at these inflation numbers?
I mean, if you look at the 4 big asset classes, okay, you've got 2 that are kind of growth focused, which are both equity and properties, or equities and property, and 2 that are kind of yield focused, okay, we've got, you know, cash and you've got bonds. You know, if you look at equities have gained in the first quarter, despite the fact that it's sitting with a fairly heady PE of 18 times earnings. You know, it's first quarter up again 4.7%. It's now probably only about 10% below its all-time high point, and that continues to accelerate. It'll probably start hitting some form of headwinds, you know, going as it continues to climb, you know, especially when it gets back to its very high point, you know. But as earnings come back into the cycle, you know, the environment is good for equities. There's nothing that's bad for equities. You look, same thing with property. You know, it's exactly the same thing with those 2 asset classes. The ones you should be concerned about, you're not really getting much for putting your money in cash.
Yeah.
You know, 12 months ago, you know, we're receiving 12% in the bank, which is just a couple of percentage points below the very long-term average that you could receive, you know, on long-term as far as equities are concerned. You're not receiving that in the cash market anymore, so therefore it's not very attractive to be in the cash market. You know, bonds, as rates move up and you know, and will at some point, you know, in the next 2 years will start moving up, there will be some form of pressure on the bond market. The problem that you face at the moment is that a lot of investors perceive the bond market actually to be riskless, rather than being in the equity market, you know, at this stage.
Being in the equity market, we see returns on the JSE about 4.5% in the first quarter. Is this the type of trend we're going to be seeing for the rest of the year or into the second quarter?
You know, I would like to see, you know, equity returns start flattening off towards the end of the year. We've had a fantastic return, you know, looking at 2009. So you'd like to see returns obviously flattening out. If it continues to do what it did in the first quarter on a linear basis, which you can't do because this is obviously equity markets, you know, your issue is that you're going to sit with a return that is beyond its long-term average again. So you want to kind of see this year that there's like an average return on South African shares. Wait for earnings to try and catch up with price. That's obviously an ideal type situation. I think most investors want to see that, because when you start seeing a trend like that, you're not going to see with this, you know, this massive drop in price, and that's obviously what causes a lot of fear. If that happens, obviously you sustain price more, the average price to earnings ratios drop, and there's again buying opportunity back into the market.
And our market is sitting above that 29,000 level mark. Well, going towards that 33,000 level mark we want to see in our market. Could we get there, and what will be driving the factors leading to that?
You know, I think the interesting thing to note about South Africa is that we never sat with the infrastructural issues that the West sat with. So we've never needed the stimulus that the West required. The bailout packages, if you talk about the TARP programs, all that, we never required any of those things. So this is a healthy economy. There's nothing wrong with it. The fiscus carries on. The monetary base is sound. There's nothing wrong with this as an emerging market. Yes, we've got to watch, obviously from a social perspective, some of the social issues in the country. And obviously we have to invest in that. And as a collective, as a South Africa collective, we need to do so. But apart from that, there's nothing wrong with South Africa. And there's no reason why earnings shouldn't continue to build and continue to drive prices higher into South Africa. There's no reason why that should stop.
And if we look at the South African consumer, still a little bit under pressure. We've got retail sales came out at 1.5% lower. Your view on the South African consumer?
If you get an inflation shock like you had in 2009, and you had inflation moving up into this very low double-digit type territories, it kills consumer confidence, number one, and secondly, it kills consumer spending. On the back end of that, as it drops, and as it does in South Africa, inflation peaks very quickly and then it drops very, very quickly and very aggressively on both sides. That starts fueling the consumer market and consumer confidence back into the market and retail sales. And we're starting to see a pickup from retail sales. We are not quite back to where we were before, but you're definitely seeing a resurgence in this. Wait another 6 to 8 to 12 months, you start seeing a lot of consumers paying off debt, and you're going to start seeing them coming back into the consumer market and sustaining, and obviously putting a substantial amount of pressure on the upside as far as consumer stocks are concerned. So it's a concern in South Africa.